Michael Burry has successfully called every last major stock market crash. He successfully shorted the dot-com bubble in the early 2000s. He famously predicted and profited from the subprime mortgage crash that kickstarted the Great Recession. And more recently, he's made a fortune off of the GameStop meme and shorting Tesla at the end of 2020. So needless to say, this guy is a certified investing genius. And in the last few months, there has been an uptick in channels covering Burry's latest short, the entire US economy, or at least most major markets, with Burry forecasting crashes in cryptos, treasury bonds, and even growth stocks like I often cover on this channel. So we're going to look at what Michael Burry means when he says the mother of all crashes is coming, and talk about what that prediction might mean for your own investing portfolio. And from the video's title, you can probably tell where this is going. But let's start by hearing out what Michael Burry is actually saying. After his profile in the public eye was lifted substantially following his dramatization by Christian Bale in The Big Short, Burry gained a large Twitter audience that he often shares his thoughts on investing with. And unlike a lot of people who voice their opinions on Twitter, he actually backs up his ideas by putting huge amounts of money on the line. So for example, back in 2019, he became an early investor in GameStop and wrote several letters to the company's leadership about the company's then wasted potential. This helped lay the groundwork for what would eventually happen on Wall Street bets, with large numbers of retail investors causing short squeezes in a battle against institutional short sellers of the stock. Burry personally profited around $100 million from his investment in GameStop, though he sold well before the stock hit its all-time high at nearly 5 times his own exit point. But Burry was never one to hold back when he thought an investment was overvalued, and he's not holding back now. Which leads us into his short, which may be his biggest bet yet. He has recently come out publicly about many popular investments. After several tweets at the end of 2020 and the beginning of 2021 taunting Tesla investors about how overvalued the EV company was, Burry reportedly had over 800,000 puts against the company, basically betting that the stock price will go down. He was also not shy about voicing his concerns about stocks such as GameStop or the SPACs being overvalued, so companies like SoFi or Virgin Galactic. He also branched out into calling out Bitcoin, Dogecoin, Robinhood, and even the stock market in general. Then in April 2021, he deleted his Twitter profile and went silent for a little over a month, before he got back on Twitter and started tweeting again. In June 2021, he let everyone know that he was shorting US Treasury bonds, and he also sent this message. People always ask me what is going on in the markets. It is simple. Greatest speculative bubble of all time in all things, by 2 orders of magnitude. This basically sums up what Burry had been saying for months. Everything from Bitcoin to SPACs to Tesla to growth stocks to US Treasury bonds were all headed for a crash, and he was willing to lay down money to bet on it. His short positions against just US Treasuries was reportedly worth $280 million in August of 2021. But why put all this money in a big bet against Treasury bonds? What was Burry seeing in the market? Well, essentially, Burry's bet is that as lockdowns end and people are free to start spending money, and with a bunch of pent-up money supply from the stimulus checks, we are going to start seeing a much greater amount of inflation than we've seen in recent years. You see, with US Treasury bonds, the price of the bond is inversely related to the yield. So when inflation goes up, so do interest rates and bond yields, and so the price of a bond drops. And also the reverse is true. When the yield drops, the Treasury prices go up. So we have had very low inflation for a few years now, despite Jerome Powell printing lots of money because of pressures from people spending less money during lockdowns. So Burry is simply betting that we will see a reversal in this pattern. But treasuries aren't the only type of investment that is affected by inflation. In fact, they all are in some way or another. If the US dollar devalues during inflation, Bitcoin or gold could be targeted by the government as a competitor to their currency, resulting in new regulations coming out that could drive their value down. Growth stocks that are heavily reliant on borrowing money to grow could face troubles as interest rates on their loans become more and more expensive. On top of all of these pressures from inflation, Burry claims the type of assets he is tweeting about are being driven by a speculative fervor, especially Bitcoin, EV stocks, software as a service stocks, and meme stocks like AMC or GameStop. Most assets are being pushed up by speculation right now, and with inflation coming, it is going to act like a weight that presses all the air out of the inflated balloon of the market. So that is a summary of Burry's basic position. But just because we can understand his argument, How then should we adjust our own investing based on Burry's prediction? So first, what do we do if Burry is wrong? Well, that's simple. We just keep investing the way we have in the past, and we ignore his warnings about speculation and inflation. But that's not a super interesting scenario. What's more interesting to consider is what do we do if Burry is right and inflation is in fact coming? What kinds of investments do well during inflation? Well, the obvious answer are things like real estate or commodities, investments that hold their value regardless of what the local currency does. But while that might be a good option for a hedge fund, what if us smaller investors want to invest in stocks instead? Well, Warren Buffett has some advice on the types of companies that tend to do well in inflation. He always wants to own a wonderful business because no matter what the dollar does, their product will always be in demand. How he defines a wonderful business in this case is number one, a business that doesn't need to keep making capital investments. A company that has already invested most of their upfront capital costs will better be able to weather the storm of inflation. So think companies like oil refineries, industrial plants, chip makers. Number two, companies that have low input costs. So something like a car maker would probably not do well since they spend so much money on raw materials, and during inflation they might get squeezed out of any profit margin that they currently have. Number three, it should be something with pricing power. Ideally, a well-regarded brand. Buffett's poster child for a brand has always been Coca-Cola, but someone like Apple might fit well into this category too. And number four, it should not be a company with a lot of debt. So small growth companies that rely on loans to keep on growing could be at risk if their interest payments become too high. From this angle, Michael Burry's own investment portfolio makes sense. His hedge fund, Scion Asset Management, holds investments in the energy and industrial spaces, so that ticks the box for high upfront capital investments. He also invests in Google and Facebook, two well-known brands with pricing power in the advertising market. He is also shorting Tesla, which has high input costs, and he is shorting Cathie Wood's ARK Invest Fund, which has a lot of money in growth stocks that may require loans to continue operating. So at this point, Michael Burry kind of seems to be making sense. But here's where he and I break in the types of companies we are investing in. One thing I disagree with Burry is equating growth stocks with high leverage companies that hold a lot of debt. While that might be true as a whole sector, it is not necessarily true on a company by company basis. Look at Cloudflare, for example. This stock is growing over 50% year over year, yet they do not have much of a debt load at all. In fact, what debt they do have is only because interest rates are so low right now, so it makes sense to use it while money is cheap. If interest rates go up, however, they can still operate without needing to give up their margins to high interest rates. And there are plenty of other examples of great, fast-growing companies that do not need debt to operate. CrowdStrike and Upstart are two other examples. Sure, if you invest in a growth ETF, you might see some major inflation headwinds. But by looking at a company's fundamentals, you can avoid at least that particular issue. Similarly, even if you're not an investor who picks individual stocks, you can continue to invest in a broad market ETF. In periods of high inflation, value stocks tend to do better while growth stocks tend to do worse. But overall inflation has not been shown to negatively impact the market as a whole. It hurts corporate profits, but it stimulates job growth. It raises input costs, but it also encourages investors to move out of cash and into investments. So inflation really acts in both directions at an overall market level. So for a long-term, steady, broad market ETF buyer, this news really doesn't have much of an impact on your strategy at all. So most of what Michael Burry is talking about is macro level impacts to the economy, which makes sense. That's done well for him in the past. But for 99.999% of investors, focusing on following a consistent strategy of investing into the market or picking exceptional companies based on fundamentals will yield you a much better return than investing based on macro events. And also remember, unless you are a billionaire, you can invest in opportunities that large hedge funds can't. That small, underappreciated software as a service startup that is growing 100% per year, but maybe has a new business model that makes hedge funds uncomfortable, you can move into that company without moving the market. For example, if Burry tried to invest in Cloudflare 2 years ago when it only had a $4 billion market cap, he would have struggled with potentially moving the market on the stock. So he has to take a more macro view for his fund to perform. But as a smaller investor, our competitive advantage is we can be much more nimble and buy into smaller companies like this earlier on. It's not that Burry is a bad investor. It's just the types of opportunities he is looking for are wildly different from those of your average investor. As for Burry's assertion that software as a service companies are over-speculated on, again, he might be right at a macro level, but on a company-by-company basis, we need to look at the fundamentals. In general, a company that has recurring revenue like a software as a service company should be valued higher than a traditional software company. This is because it takes them less effort to grow every year. Think about it. If I sell 10 widgets this year, I need to sell 15 widgets next year to get 50% growth. But then I need to sell 22 and a half widgets the year after that to continue that 50% growth. But with a subscription model, if I have 10 subscribed customers this year, I just need to maintain my existing customers, then sell to 5 new customers next year for 50% growth. Then I need to sell to 7.5 customers the year after that for another 50% growth. This means that revenue from a subscription source is inherently more valuable than one-time sales. To really drive home how important it is to always base your buying and selling decisions on company fundamentals and not macro market events, let's look at when Michael Burry was making his tweets. 3 months ago, a few weeks after Burry said we were in for the mother of all crashes, my portfolio was 40% less valuable than it is today. If I go back 6 months, it was 65% less valuable. I'm not using this to say that Burry was wrong because after all, the market could crash tomorrow and prove him right. What I am saying though, is that there is a very real opportunity cost to pulling your money out of the market due to macroeconomic fears. Going back to 2017, we can find plenty of articles talking about how we were going to see the next 2009 recession soon, or another Black Monday-like crash from the 1980s. Even Michael Burry himself talked about how index funds were overvalued all the way back in September 2019, and the S&P 500 has more than doubled since then. It's hard enough to find great companies to invest in. It's way harder to also try to time the general market based on things like inflation. So Michael Burry may be a genius, and his investment strategy has worked for him. But if you're looking for useful information to make you money through your investments, you're better off going to the same sources that Burry used when he first started out. People like Benjamin Graham, the godfather of value investing. It's not hard to find information on the internet, but it is very hard to filter out what information is actionable and what is interesting, but really just noise. But let me know in the comments if you agree or disagree with me. I'm sure a few people will have a strong opinion on this. Don't forget to like and subscribe, and I'll see you next time.